Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The long-term construction of bearish patterns continues. Initially, this had been in the form of a somewhat sideways rectangle pattern, currently 1578 to 1734. Then the market veered towards a shallow bear channel, currently 1479 to 1657, and more recently towards a breach, June-based bearish shift pitchfork, with the market moving down between the upper tine, currently 1540, and the middle tine, currently 1473, and also the lower tine, currently 1406. Most recently, as in the last week or so, the market had breached the lower bear channel line, the middle and lower tines, as well as the slowly rising long moving average, currently at 1480, plus the 50% Fibonacci line of the interesting December 2020 to February 2022 move at 1451. One could say that all these patterns and levels had been broken rather than breached. However, some were done by changeover rather than by direct action, so I'll leave them on the daily chart for now. What we have most definitely seen is a move down to reach a primary target X in the 1482 area. This target was for an older sideways triangle that had become synonymous with the more recent sideways rectangle. Secondary, harder to achieve target X1 in the 1400 even area is still below. On this matter, I said 3 weeks ago, and I quote, "This long moving average is the main obstacle to reaching down to target X1 below." And that's in the 1400 area. There are two other factors that should be considered. Firstly, breaks below rectangles fare badly, really badly, compared to breaks above. Additionally, we also have the now strong possibility that we'll have a possible monthly key reversal here. Well, so far this breakdown below the rectangle has been good, but this market is still having issues in untangling itself away from the long moving average. Once that is done, then we can start looking at target X1 in the 1400 even area. Then there is the case of the monthly key reversal down. Yes, we have made a monthly key reversal down, and in all our dealings, this action should be borne in mind for now, but it doesn't directly impact its a longer term pattern. Chicago soybean meal. Okay, so I've previously spoken at length about the topping action over late January to late April that turned out to be a head and shoulders top with a split head. In late April, the market breached and closed below the neckline, which is currently 452.40, and triggered the pattern, which subsequently fulfilled all the opportunities, primary and secondary, on the downside. Now, a significant portion of the erosion of the move lower has been, and is still out there. It is the market's reluctance to test the slowly rising long moving average below, and that's currently at 405.70, as well as, well, initially it was the 50% Fibonacci line of the August 21 to March 22 move at 386.80, but more recently has been the nearer 50% move at 50% Fibonacci level at 400.50 of the October 21 to March 22 move. The latter had been breached but not broken during June. The most recent feature has been the completion of a small late May to June based triple bottom, with the start of a subsequent move higher. At the same time, and probably related to this move, a break higher over the declining short medium moving average, currently at 416.90. Now, these breaks higher came with some issues. Well, don't they just always come with some issues? These are the issues. Immediately overhead is the combination of the old early April 2021 high plus congestion highs from January and February 2021, all at 433.5. However, I suspect the resistance is running out not to be as impressive, or turning out not to be as impressive as my words suggest. You see, at the top of the recent market, we have the combination of the April 21 high at 439.30 and the flatlining medium moving average, currently 437.10. It is these two, especially the latter, that will be the obstacle to overcome. Now, so far we've seen the market reach and breach it, but no closes over this key resistance, those key resistances. Finally, there's the longer term pattern that needs to be considered. I described it thus 6 weeks ago, and I quote, "The second possible longer-term pattern, should it come about, may be strategically massive. It is to regard the whole action since mid-December 2021 to date as a huge head and shoulders pattern. This head and shoulders pattern has the original February to April action as a head and shoulders top, as a crown on the large head and shoulders pattern." Now, before you start jumping to conclusions, yes, head and shoulders patterns, as we have seen here recently, are usually regarded as topping patterns. But, and this is an important but they can also be possible continuation patterns higher. And just because the last head and shoulders pattern seen here was a topping action does not mean that this larger one will be, or in other words, post hoc ergo propter hoc. And I think it is really important to stress that point. That's the end of the quote. The neckline here, currently at 399.70, is closely associated with the long moving average, currently 401.70, and the 50% Fibonacci line at 400.50. The neckline and long moving average have been at the core of what has held up this market. Well, holding up the trigger for this larger head and shoulders pattern is seemingly turning it towards a continuation pattern. A continuation pattern higher, as prices today are following on higher from yesterday's combined immediate countering key reversal up and bullish engulfing pattern. Today, prices have again pushed up over the medium moving average, only they're using the congestion highs at 433.5 as a base of action, punching up through the April 21 high. If this does indeed turn out to be a continuation pattern, then there are some things to look out for. Firstly, keep an eye on the action since about the start of May to date. Typically, we may see a reverse head and shoulders pattern here, with the triple bottom as the crown on this reverse head and shoulders pattern being formed as part of this the bigger continuation pattern. Thus, we now have a prospective neckline for this pattern, currently at 447.60, which is where the market has stopped today. Beyond the medium moving average and the April 2021 high, this will be the next test to see if this recovery has some legs on it or not. We are testing it. We haven't broken it. We haven't closed over it yet. We're just testing it. Chicago soybean oil. The market made a new all-time high at the end of April. However, the peak on the last day of April was made with a bearish pattern, bearish engulfing pattern, if only just. And we subsequently saw prices fall down, even gapping down lower, down until just after mid-May, when they seemingly stabilized, caused by a combination of the 50% Fibonacci line, the February to April move at 75.24, and perhaps more importantly, the then rising short medium moving average, currently at 74.72. However, in mid-June, on Thursday, the 10th of June to be exact, the market made a bearish belt hold pattern, a pattern that is one of the most consistently daily bearish patterns available, so hence its rarity. Prices dropped again after that, much more aggressively, halting 3 weeks ago, not at the low, 67.04, long moving average, which is where one would have expected to see a halt. Though they did have some strong calming influences on the market, but at the 50% Fibonacci line of the big January 21 to April 22 move at 64.09. The reactionary move back up from there only lasted until June 21 high at 64.84. This past Monday, and we've seen prices resume their journeys lower ever since. Now, we have seen the congestion band between 57.64 and 59.44 halt the market, but it has been breached today, though the market is currently still in there, if you like, not willing to emerge either side. There are 4 questions now that need to be answered. The first one is easy. Will the short medium moving average, currently 74.71, and the medium moving average, currently 74.15, make a dead cross? This seems likely, but we'll have to wait and see. Second is also easy to answer, though it's not time yet, and that is whether we'll have a weekly key reversal down this week. You see, if we close on Friday below 62.59, then we'll be on. Closing over 64.43 would mean a weekly key reversal up, and a close in between would mean an outside week. Right now we are looking at a weekly key reversal down. The last 2 questions are more difficult. We have the possibility of 2 bear flags from the June to date action. The first one has potential target X in the 51.55 area, and the second has a potential target X1 in the 52.25 area. These last two are harder to read as we're stuck in this congestion zone, but they are there as potential targets on the downside. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.